And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
And welcome to my podcast. Today, with so much going on in the market and the uncertainty, there's one thing we are certain about. There is going to be a crash. We're not going to get away with not having a crash. The problem is this, that the folks with 401ks have no idea what's going to hit them. And 401ks is a terrible product. It's a failed experiment. That's not me saying it. That's the person who came up with the idea, Ted Benner. Says it's a failed experiment. A 401k returns about 2%. That's right, 2%. And I'll show you how we get there. But first of all, spiders, let's take spiders versus 401k over 25 years. So let's go through the numbers. So again, you have a person, let's say a person puts in $500,000 in a 401k. Person B puts $500,000 in the spiders. After 25 years, the 401k will have $2.1 million. The spiders will have $5.7 million. That's a $3.5 million difference. What are you, nuts? Now, what is the difference? What's it caused by? It's called imperfect behavior. Now, when they quote quote the returns on 401ks, it's always about 5 to 8%, which is a bold-faced lie. That would only occur, and when they say that, they're basing it on assumptions that you're going to have perfect behavior. And that is just nuts, because you're not going to have perfect behavior. Nobody has perfect behavior. It just doesn't exist. So on a scale from 1 to 10, imperfect behavior, or what causes you to get lousy returns on a 401k, is imperfect behavior. On a scale of 1 to 10, it's about 8. So let's think about it. Retail 401k investors, they always sell during downturns. They always do that. They buy after rallies. They're called FOMOs. They're fearful of not getting in. They switch funds right at the exact wrong time. And they stop contributing when they're scared. And they always chase last year's winners. And they always panic when volatility hits. So again, advertisers will claim 5 to 8% return with an assumption you're going to have, good behavior, proper behavior. And that, just think about that for a moment. What a con job that is, isn't it? That's awful. I mean, and people fall for it. I mean, they really fall for it. So perfect investor behavior never sells during crashes. They stay fully invested through the downturn. They never chase performance. They don't jump into last year's hot fund. They never stop contributions. And even when the market's falling, they keep buying. Now, they rebalance on schedule. They don't guess. They follow fixed plan, and they ignore the news. They follow the money. So to be that disciplined and continue to, at the same time, you're continuing to listen to CNBC, the financial show, the financial shows on Fox, Bloomberg. The people will never do that. They're always scrambling for the hot stock. They always have a pen and paper, and when they turn on TV, especially Kramer, they always mark down the stock. So, now it also assumes to get to your 5 to 8%, they assume you got perfect investor behavior, and they assume there's no hidden fees, no fund turnover costs, no revenue sharing fees, that's a big one, and no wrap fees, no target date glide path drag, and perfect investor behavior. So that's just all nonsense, we know that. So if you really take a look at your 401k, the returns are really about, if you're lucky, you get about 3%. With cost of living, it gets down to 2%. 2%. Now, that's a terrible, terrible thing. And the other problem is you have not only the fees that are terrible, but you have 3 different groups managing the fund. And each one of those groups slam you for fees. I mean, why do they need 3 different groups? That's stupid. It's because they're all getting the piece of action. They're all stealing from you. 3 groups. So your bad behavior, on a scale from 1 to 10, your losses is 8. And then you got, again, these bad managers, and Fidelity, Vanguard, T. Rowe Price. Now, when you work for a company, you join a company, you get a 401k, what do? There's no education, there's no schooling. They hand you a pamphlet, log in, and say, hey, good luck. And they say, good luck, good luck. So now, man, the reason why you're only going to, let's take the cost of living out, inflation out. So let's move it up to 3%. The reason you only end up with 3% because you got bookkeeping, you got Fidelity, they're doing their management part, which is to take your money. And Vanguard, they do their part, they get a piece of the action, and T. Rowe Price. Those 3 take your money. So that's the big problem. And again, there's just no way that you should be in a 401k. And you never can talk people out of it because they always say, but I get a match. Well, the match doesn't do you any good, okay? Because you chew through that match so fast with hidden fees and you know, the bad behavior as an investor. So that's, no one's going to be truthful, okay? So think of the spiders giving you a consistent 10% return. Now let's talk about shorting. 401ks, you can't short, okay? You can't short a 401k. Now the argument is, well, the fund, the spiders, they don't short either, which is true. But you can hedge. You can hedge your 401k. So when it starts going down, you're making money replacing the money that's losing by doing an inverse ETF, like SDS, which is the spiders. So, but just remember, the next time people tell you about the returns you're getting on 401k, it's a bold-faced lie, but the spiders are consistent. Actually, it's 10.7%. 10.7%. That's what's going on there. So again, the retail investor, okay, when the pension fund was taken away from us, the pension fund was a golden beautiful thing. When the pension funds, because the pension funds, there was an understanding between the workers and the company. The company would say, look, we're going to make sure you have a real nice retirement. We just want you to produce a great product for us at a very, very low cost. And that's what they did. And pension funds, you had a great incentive to do that because you didn't have to you could be in the first year of high school, you could just leave at lunchtime and say, I'm not coming back to school, go down and start working for a company. And you were part of the pension fund. And when you retired, you'd have a nice house, okay, it'd be paid for, cars be paid for, and you have no education. That's what pension funds did. They're a wonderful thing. But what happened was the pension funds, the greedy CEOs and the board of directors, they didn't want to pay the fees. They said, these are too expensive to manage. So that's why they went to 401k. And remember, that's when they started, outsourced to China, Japan, and all that. So anyways, so that's the truth about 401ks. I want to get into something else, though. If you have, again, I'll just give it to you here for a minute. Let me just move this over so I don't screw it up. Okay. So we are in a situation right now, there's no question we're going to have a crash. And we're going to identify that crash, okay, starting with the first thing you're going to start looking at is sentiment. So sentiment is a good thing because sentiment gives you an indication. It gives you what's the emotion of investors, what's going on. And then you start looking at your transportation. So if you put up your transportation symbol, IYT, and you see transportation going up, just track SPY with it. And if SPY keeps going up and your transports are going down, indicating a correction or crash, that means that we are shipping more stuff than we have too much in the pipeline. We keep making stuff, but we don't have buyers. And we know that by looking at transportation. It identifies demand. Now, rail identifies industrial. Okay, and if rail is strong, then we know our industrial stocks are strong, and that's when we start trading Caterpillar and Honeywell and all those stocks we're in. And trucking also gives us demand. If trucking starts falling off, demand is falling off. And air freight is another one. So between your transportation, between rail, trucking, and air freight, you have a good idea what's going on when this crash is going to occur. Crashes are no longer a surprise or a shock, okay, if you know what you're doing. Now, the next thing, of course, is IWM, and we talk about IWM all the time because IWM, on a scale of 1 to 10, is probably an 8, but when you look at spreads, okay, spreads are about a 9. But the problem with spreads, they're laggers. So, but you can tell today, if somebody says, what do you think the market's going to do? Go look at IWM, and it's going to tell you exactly what it's going to do today, okay? It's a truth serum. The beautiful thing about IWM, small mid-cap stocks, the Russell 2000, it's a bridge between Wall Street and Main Street. So you can tell what's going on, why they lie every day, Wall Street and these TV shows, financial TV shows, because they got to be optimistic. IWM can tell you what's going on. Credit's tightening, okay? It tells us our economic health, consumer weakness. It'll tell us about loan demand, borrowing costs, all these things. So IWM, you can see quickly if things are going south. So small caps are good. It tells you, hey, okay, we're in trouble. The rally is narrowing right now. So when you see IWM going down, and you can see right now, what we're seeing right now is the spiders. Okay, IWM is lagging behind the spiders. If you look at if you look at this, here, I'll show you. If you go to the charts, let me just show you, it'd be easier to do. So if you go to the chart and you look at, let me get this up here 1 second here. If you go to the charts and you look at, let's go look at IWM for a moment. Okay, so IWM, here's IWM right here. And then you look at then let's compare it with your spiders. This is a beautiful thing about IWM. Again, the credit spreads are better, but this will tell you. IWM is showing you how it's really disorganized, big pullbacks, really sloppy. The spiders, look how nice and even the spiders are. So it's telling you we're in trouble, that IWM, small mid-cap stocks, are really in trouble. And when you go look at your tech stocks, we know we're in trouble. So don't ever think that you don't have any heads up for a crash. You do, and we'll show you what they are. philsgang.com. Join us.
Are you nuts?